Hello, everyone, and welcome. I am so excited to have you join us today. My name is Linda Williams. I am a community outreach and training manager with Consumer Action. Today, we're having a policy focused conversation on the growing use of FinTech app and the driving data privacy concerns. And you are in for a real treat. Facilitating today's session is Consumer Action's Director of National Priorities, Ms. Linda Sherry. Now, before I turn it over to Linda, let me give you some background on Ms. Sherry. Linda is one of Consumer Action's chief spokesperson. She is a nationally recognized consumer advocate who is well versed in consumer rights, responding often to requests for interviews and background information about consumer product protection issues from the media, Congress, and federal regulators. Linda and her DC based team participate in many leading coalitions working to protect and improve consumer protection for personal finance products, privacy rights, access to justice, and consumer practices. And she was in the Rose Garden when President Barack Obama signed into law the CARD Act. So buckle up and please help me welcome Miss Linda Sherry.
Thanks, Linda. Got to get used to all these buttons here. Welcome, everyone. We're very glad to have you. We have a very interesting presentation for you today with three expert speakers. Today, we're going to review some consumer research, new consumer research by the Clearinghouse, and we're going to talk about how consumers use FinTech apps, what their concerns are, and the risks and benefits of these apps. We're going to talk about what regulators and the industry are doing to improve the safety of app use and to provide consumer control of their data. Principles and standards for safe data sharing will also be discussed. Now, what we have first, which we do in many of our webinars, is a quiz for you, the attendees at this webinar. And if you can press some buttons on your computer, you can actually respond to the quiz. So let's play the game. Linda?
Thank you, Linda. This is how the game is played. We have four questions. All are either true or false. I will read the question and you will answer the questions by using the poll function on the right of your screen. At the end of the game, the person with the most correct answers walk away with the bragging rights. So how much do you know? Are you ready to go? Okay, let's roll out the first question. When you connect your bank accounts to a financial technology app, the app can regularly access your banking data even when you close or delete the app. Is that true or is that false? Come on now, common sense. When you connect your bank account to a financial technology app, that app can access your banking data even if you close or delete the app. Is that true or is that false? Okay, let's close the poll and look at the results. 89% of you think this is true. 11% thinks it's false. Where 11% you are actually wrong. It is true. Once you connect your bank account to a FinTech app, it can continue to access your transactional data from your bank account until you change that banking password. Okay, let's move on to the next question. FinTech apps are prevented by law from sharing or selling information about you to third party for marketing purposes. Come on now. FinTech apps are prevented by law from sharing or selling information about you to third parties for marketing purposes. Is that true or is that false? Don't overthink it. Don't overthink it. Okay, let's close the poll. Look at the results. 11% of you think it's true. 89% think it's false. Well, 89% you are absolutely correct. Many apps provide their services for free. Why? So that they can gather information about the customer and then sell it to marketers. Let's move on to the next question, please. FinTech apps use a third party to facilitate access to your personal and financial information. Is that true or is that false? What third parties? FinTech apps uses third parties to facilitate access to your personal or financial information. Is that true or false? Don't overthink it. Okay, Let's close the poll and look at the results. 89% think that is true, and 11% thinks it's false. Actually, it's true. FinTech apps often use third parties, behind the scene technology companies that serve as middlemen to FinTech to deliver customer financial data for use by the app. Isn't that something? Okay, let's go to the last question. FinTech apps' term of service can require users to waive consumer rights for unauthorized transfers or payment. Is that true or false? FinTech apps' terms of service can require users to waive consumer rights for unauthorized transfer or payments. Is that true or correct? Come on, don't overthink it. All right, let's close the poll and look at the results. So 78% thinks this is true. Only 23% thinks it's false. 23%, you are absolutely correct. It is false. The Consumer Financial Protection Bureau, the CFPB, recently emphasized that financial institutions, including fintech app providers and data networks, can't require customers to waive their rights under the Electronic Funds Protection Act because the FTA includes an anti-waiver provision that provides an agreement with consumers may not contain any waivers of any rights. How about that? Thank you for playing the game. Let me turn it back over to Linda.
Thank you, Linda. That was great. I have to give a pass to some people who got the last one wrong because it is a recent, the CFPB recently came out and reiterated its rules in this regard. So you may have missed that, but it has been the law all along, but they did reiterate it recently. And I just wanted to say that I missed my cue to thank Linda Williams and my other colleague, Nelson Santiago, who are our outreach workers and who do the webinars on a regular basis for facilitating and helping me out with this today. I wanted to tell you a bit about our educational project. It is funded by the Clearinghouse, as you saw on one of the previous slides. And we launched this educational project last year to raise consumer awareness about how financial services applications, AKA apps or FinTech apps, access, collect, store, and use and share customers' personal information and how they can control and protect their financial information when using FinTech apps. Providers know customers like these apps because they can help users gain a fuller picture of their overall personal finances and assets. They can manage their money more effectively, they can make savvy purchasing choices, save money, and monitor their accounts for unauthorized use. But careless use of these FinTech apps can lead to fraud and loss of privacy. Our goal with the project is to suggest ways to use these apps in a safer manner while preserving the benefits they offer. Now, as part of our project, we have, you can move along, Nani. As part of our project, we have a film and we have a landing page that we'd like to share with you. Would you move the slide, please? One more. This is the landing page that we've created, and it's available at the Consumer Action website, and it has lots of resources, fact sheets, studies, webinars, and videos. And we're going to actually play you a quick video that's about a couple minutes long. So here we go. Nani, would you play the video?
Banking, investing, budgeting, saving, and paying your friends back for dinner. Financial technology, or FinTech apps, have become a staple of daily life. But when a popular new service takes off, it's always worth taking a few extra precautions. Being security savvy is the best way to keep your financial data safe. So here's what you need to know. First, the basics. When we give FinTech apps access to our financial accounts, the apps store our usernames and passwords. They can then access our accounts anytime and share that data with third parties, regardless of whether we even use the app anymore. And many FinTech apps assume limited liability for security breaches, making it difficult or impossible for us to recoup any losses after a breach. In short, we often don't have much control over how FinTech apps collect and share our data. But equipped with knowledge and a few precautions, we can enjoy the convenience with peace of mind. Here are our top tips to keep your data safe. First, discontinue service with any FinTech apps you don't use anymore. Deleting the app won't deactivate your account, so be sure to disconnect with the app provider. If you're not sure which apps have access to your financial information, simply change your financial institution user ID and/or password. This will cut off apps' access to your financial institution, and you can update the login with the apps you still want. Read the app's terms and conditions along with the privacy disclosure. We know, boring, but this is where you'll find important information, such as what data the app will access, who they share it with, and who is liable in the event of fraud or a data breach. It's need-to-know stuff for FinTech app users. Opt in to receive security and account updates from your financial institutions and credit card issuers so that you're always in the loop about changes or security risks. And lastly, check out the resources available from your financial institutions for safely using FinTech apps. Some financial institutions track which apps access your accounts, the information that they gather, and give you the ability to manage access directly from the financial institution's website. The financial services industry is working with FinTech app developers and consumer groups to make data sharing safer and more transparent. But ultimately, staying security savvy is the best way to look after your financial data. For more information, visit www.consumer-action.org/fintech-privacy.
This whole project is an educational project funded by the Clearinghouse, and they've also graciously agreed to fund this webinar today. So I would like to introduce our speakers. The first person up will be Rob Hunter, Deputy General Counsel of the Clearinghouse. Rob is Deputy General Counsel and Director of Legislative and Regulatory Affairs for the Clearinghouse. The Clearinghouse is the nation's oldest banking association. He represents the interests of the Clearinghouse owner banks on a variety of payment law issues at meetings with financial services regulators and members of Congress, and through comment letters, amicus briefs, and white papers. Rob holds a bachelor's degree from Bachelor of Arts degree from Northwestern University and a JD degree from the Duke University School of Law. He's a member of the American Bar Association Business Law Section's Banking Law Committee, that's a mouthful, where for many years he served as the chair of the Subcommittee on Payments and Electronic Banking. Rob is a frequent speaker and writer on payments and technology issues. I'm going to run through everyone's bio first, and then we'll hear from the speakers. Next slide, Nani. Stuart Rubinstein is CEO of Akoya, a startup whose mission is to transform the way consumers share their data by providing them with increased security, privacy, and control over their information. Stuart has spent over 30 years in the financial services industry as a digital leader, and prior to Akoya, served as president of Fidelity Wealth Technologies. Stuart has testified on consumer permission data access and data privacy before the U.S. Senate Banking Committee and the U.S. House of Representatives Financial Services Committee. He holds a bachelor's degree from the State University of New York at Albany and an MBA from New York University. Next slide, please. Our third speaker will be Daniel Murphy, Dan Murphy, Policy Manager of the Financial Health Network. As manager of the program team in the Financial Health Network Washington, D.C. office, Dan Murphy focuses on policy and leads the Financial Health Network's work on consumer data rights. Dan is interested in the intersection of competition policy, data governance, and finance regulation, and believes in working towards an economic system that allows consumers to live financially healthy lives. Prior to joining the Financial Health Network, Dan worked on FinTech policy at the Milken Institute Center for Financial Markets. He has also worked at the Democratic Senatorial Campaign Committee and the World Bank. Dan holds a Bachelor of Arts in Political Science from the University of Pittsburgh and a Master's in Public Policy from the Hertie School of Governance. So first up today, we're going to hear from Rob Hunter, who's going to discuss some research done by the Clearinghouse. Next slide, please. Go.
Thank you, Linda. It's nice to be with all of you this afternoon, at least virtually. Hopefully someday soon we can get back to doing these kinds of events in person. The Clearinghouse, through our Connected Banking program, has been working since 2016 to transform the process of financial data sharing from credential-based access and screen scraping, which involves the sharing of consumer bank login, platform, IDs, and passwords, the same information that consumers use to log in and transfer money from their bank accounts, to a safer, more secure application programming interface or API environment, where consumers don't share their login credentials and have greater control over the information that is collected and shared with their financial applications or apps. As part of that work, we have done numerous surveys and studies of consumer attitudes about data sharing. And in just a minute, I'm going to share the results of our most recent update. But before I do, and particularly since the video didn't work, I want to do a bit of level setting and talk about a typical financial data app data flow that uses credential-based access and screen scraping. So if we can go to slide 2, the next slide, you'll see a typical data flow. So typically a consumer finds a really neat app that they believe will be helpful in managing their financial affairs, or maybe providing a novel platform through which they can transfer money, or maybe promises an easier way to apply for a loan or credit. The consumer signs up for the app, creates an account, and oftentimes, unbeknownst to the consumer is then passed by the app to a third-party data aggregator, a company that provides the app with data. And with the data aggregator, the consumer puts in the consumer's bank platform username and password. The data aggregator uses that information to sign into the consumer's account with the bank and launches a bot that typically screen scrapes information from the bank's internet banking platform. The data aggregator then transfers this information to the app. In credential-based sharing and screen scraping, the bank has no relationship with the data aggregator or the app, and the bank may not always know that it's the data aggregator rather than the consumer that is accessing the consumer's account. While the original app types were engaged in data access that tended to be financial management application in context, that assisted the consumer by aggregating all of their financial records and accounts in one place, the practice has now significantly expanded into the movement of money for payments. So you've got third-party FinTechs out there actually moving money on behalf of consumers. Once a consumer signs up for an app, screen scraping typically continues, often multiple times a day, until the consumer takes some sort of affirmative action to stop the data access. And that affirmative action typically has to be something more than simply deleting the app or not using it anymore. The Clearinghouse's owner banks, which are some of the largest financial institutions in the country, estimate that up to 50% of all sessions on their bank websites are actually from data aggregators. So it's a significant presence in the market. Many of the companies engaged in this activity are sizable. Some of the largest apps like Venmo and Cash App have as many customers as the largest banks. And data aggregators like Plaid, for example, are estimated to have banking data and hold banking data on over 25% of the accounts in the US. So again, quite a sizable presence in the market. The next slide talks about our consumer research. The Clearinghouse's research on consumer understanding around data aggregation practices dates back to the first quarter of 2018 and was recently refreshed in the third quarter of 2021. As you will see as we work through the slides, in spite of the dramatic growth and prevalence of financial apps and data aggregation practices, really little has changed in terms of consumer understanding of what data is shared, how it's shared, and which parties it is shared with. If we go to the next slide.
Rob, I just want to tell you that they are going to have to operate your slides for you, so.
Got it. Okay, thank you. Then I will provide those verbal cues. If you go to the next slide, at a high level, the research shows that while consumers feel confident and secure when using financial apps, they actually don't know very much about what's happening behind the scenes or the terms and conditions that they are often agreeing to. 77% don't read all the terms and conditions, and 80% are unaware that a third-party provider, a data aggregator, and not the app itself, is gathering their financial data. You all scored much better on that question than the average consumer did. If we go to the next slide, our research shows that consumers fundamentally don't understand that the apps they are using have access to their personal financial information. This chart by category shows the percent of consumers not aware that the app actually has this personal information or that their information is being screen scraped off of the bank's website. Even when consumers are providing their username and password as part of this process, the majority of them don't think that the apps have access to that information or data aggregators have access to that information or other information commonly found on their account pages, such as bank account number, home address, card numbers, etc. If we can go to the next slide. This slide shows the disconnect between consumer awareness and their discomfort when they learn of actual data sharing practices. So the gold line that you see at the bottom of these bars is the percent of consumers who are aware of a particular app's abilities. And the green bars show the percentage of consumers who are uncomfortable when they learn of the actual practices. We all know that very few people actually read the terms and conditions that govern app and data aggregator practices, but the terms for these parties, in the absence of meaningful regulation and supervision, can often be troubling. Most consumers simply don't know that these parties can access their accounts as often as they want, can store the data forever, unless the consumer takes some sort of affirmative action beyond deleting the app or not using the app anymore, to remove their data. Oftentimes the terms and conditions indicate that the data aggregator or the app can sell their data to whomever they want. And if anything goes wrong, the terms and conditions specify that either the app or the data aggregator either aren't liable or are liable for a very minimal amount, say a couple $100, when the consumer has given the data aggregator and the app full access to the information contained in their accounts, and oftentimes the ability to transfer money. If we can go to the next slide. Finally, you can see that what consumers want is transparency and control. They want better and clearer explanations of what data is accessed, who has access to it, what the risks involved might be, as well as greater control over access, like the ability to easily limit it or stop parties from accessing the data if they aren't using the service anymore. That is the world that the Clearinghouse and the others engaged in this webinar are working very hard to build. And you're going to learn more about that throughout the course of this program. Thanks very much for your time today. I look forward to addressing your questions later in the program.
Hi, it's Linda again. I'm just popping in because we're going to hear now from Stuart. And I wanted to let Stuart and Dan know that we are having a glitch. So Nani will forward your slides. Just let her know when you need her to do so. Thanks.
Okay, great. Thank you, Linda. And thanks everyone for having me here today. That was a great introduction by Rob with the research from the Clearinghouse. As Linda mentioned earlier, I'm the CEO of Akoya, and I've been asked today to provide a brief overview of what the financial services industry is doing to ensure the safety and security of financial data access. This is an area where consumer groups and banks are aligned, and really was the impetus for the start of Akoya. We can go to the next slide, please. Consumer data security has always been critical to financial institutions, but why is it a hot topic now? Well, the financial world has changed dramatically, and I think the pandemic actually accelerated that. The number of FinTechs has doubled over the past few years, and as a result, innovation in financial services is accelerating. Open finance, is more than just open banking. Open finance is the free-flowing, transparent sharing of consumer financial data that extends the third-party access principles of open banking, which primarily just started to focus on payments, but now it's involved in mortgages and other types of lending, investments, and much more. My company, Akoya, is aimed to bring responsible data sharing to this burgeoning ecosystem. Let's go to the next slide. This is a different depiction of one of Rob's slides on what has been happening. So for the last 20 years, really from the advent of banking and brokerage and other financial services on the World Wide Web, consumers have been using data aggregation in smaller numbers and now growing very rapidly over the last several years to access their data. But the way it's been happening, as Rob said, is consumers have been giving their credentials to a third-party app, to some app, who then has given their credentials to a data aggregator. The data aggregator stores that, and then using a robot that imitates the consumer, accesses the data at a financial institution. We'll stick with banks to make it easier for this presentation. So accesses a bank. When the data aggregator has those credentials, they can access each and every page on the bank's website as if the consumer was doing it herself. So that's where consumers think maybe that they're linking their Venmo account for payment, and there's only a couple of data fields that are required, but unbeknownst to the consumer, the data aggregator actually has access on an ongoing basis to every page on the website. This is causes a number of issues. One, the data aggregator and possibly the FinTech, but certainly the data aggregator can access more information that the consumer permissioned. The consumer, when they stop using the app, doesn't realize the data aggregator still has access to the credentials and access to the account, so the data aggregator can continue to access that data on an ongoing basis. And the consumer has no way to monitor what is being accessed, who is accessing it, and for how long. So if they start to use an app and they don't use it anymore, but they forget, there's no way to monitor that ongoing access. So we founded Akoya to fix that. And if we can go to the next slide. So Akoya was created to overcome those challenges and scale API application programming interface adoption for the industry. There were some logos down here. Akoya was actually founded inside of Fidelity Investments, but we spun it out February of 2020 to be invested in by an industry consortium to solve the problem for the entire financial services industry. And if we go to slide 5, so the next slide, that one, thank you. By embracing APIs, we actually enable safe, secure, transparent sharing information. And the way this works is we at Akoya, unlike other data, let me go back one slide, I'm sorry. We at Akoya never get the client's credentials. We act as a pass-through. So in this case, when our client Emily wants to access her financial institution, when she requests that from a FinTech app and that app comes to Akoya, Akoya would redirect Emily to her financial institution. So the way I like to say that is the financial institution should be receiving specific instruction from Emily directly to allow a third party to access her data. The same way as if I walked into a branch and asked to access your account, right? If they didn't have specific instruction from you to give me the information right at the teller, right, I would not get it. Right? That's the way it should be happening in the digital world as well. So Emily should be logging in and authenticating directly with her institution. This allows the bank to ask her any security questions they want, use any security method. It could be biometrics, it could be Face ID on the phone, it could be a SMS message, but it could step up security in any way. Emily, working with her bank in this case, can then choose the specific accounts that she would like the third-party app to get. And then Akoya, in this case, would transmit that data back to the FinTech app, or possibly a data aggregator if they're involved, but back to the app, only for the accounts that Emily selected. We go on to the next slide. The next slide shows how some of that is done. Here, go from the FinTech app over to the bank. The purple on the right is a bank we created for demonstration purposes on an app, the Como Bank here. So you can see Emily is signing in there with her bank and authorizing the bank. Once that happens, tokens are exchanged between Akoya and the FinTech and between Akoya and the bank. So Akoya actually doesn't even know who Emily is. All we know is a set of anonymous tokens, so we can transmit the data back and forth. We do act as a pass-through, so we never store any of the client data. So Rob mentioned that one particular data aggregator has 25% of bank customer data in their warehouse. That's more than any single bank has themselves. We at Akoya have 0. We go on to the next slide. This actually just keeps depicting how the authorization code is set, that Emily can then see all her data in the app. What we also do is provide a way, when we go one more slide, we provide a way for Emily to keep track through her bank of what she's authorized. So if you look at the middle screen here, you can see Emily has authorized her checking account, her savings account, her basic savings, but not her money market account. So Emily gets a dashboard to remember what she's authorized, and she can make changes to that at any time. So what's very important here is Emily should give that authorization, be able to monitor that on an ongoing basis, and be able to revoke that consent and revoke it instantly whenever she wants. We go on one more slide. So how does Akoya differ than what's been happening in the marketplace? Number one, we don't store any customer data. So we're not creating yet another target of attack. We're not creating another place for an accident to happen. It's strictly a pass-through. We're not creating a shadow database of anyone's bank accounts. We're not storing customer credentials. So think about the risk involved with 25% of bank account credentials stored in one place. Not storing customer lists. So there's no fear of, from a competitive standpoint or from a risk standpoint of a customer list being stored somewhere else. Akoya's principles are not to resell customer data. We're acting as a transport layer here. We're acting like the post office. Think about the post office. The post office's job, USPS's job, is to pick up a letter and deliver the letter. Imagine if it arrived opened and it was scanned and collected and aggregated and analyzed and sold to third parties. Imagine how we would feel, and there would be a revolution. But that's not what the post office does. They pick up and deliver the letter. But that is what data aggregators are doing. They're actually analyzing that data and doing it for other purposes. Rob mentioned selling data. Often terms of service, the customer's terms of service will basically say for data use that a data aggregator can do anything permitted by law. And that's not very transparent. So we wanted to make sure we don't do that. For data formats, we are compliant with the industry work around the financial data exchange, so anyone can plug into us. And then all of our work is by APIs. I'll probably just leave it there so we can get on to Dan, but I'll be here to answer any questions. Thanks.
Hi, everyone. My name is Dan Murphy. I'm from the Financial Health Network, where I'm a policy manager. First, I just wanted to thank Consumer Action and Akoya and the Clearinghouse for hosting today's group and for inviting me to come participate and present some research. If we want to advance to the next slide. Just to give a little bit of background, first of all, on myself and my organization, we've been active in this space on consumer financial data rights for some time, going back to 2016. We issued our set of consumer data sharing principles, which I think we're pretty early in the space. We've also done some work last year, a legal and regulatory analysis on consumer financial data that, if you write to me after, I'm happy to share, as well as numerous comment letters, and most recently a Brookings report on the need for legal and regulatory, legislative and regulatory action with respect to consumer financial data. So happy to share all of that, but today I'm here to really talk about a report that we did earlier this year, Financial Data, the Consumer Perspective. And I think this is quite complementary to some of the work the Clearinghouse has put together from their consumer data sharing initiative. And I will be happy to talk about not only what consumers understand and don't understand about FinTech data sharing, but also about bank data sharing and big tech data sharing. If we want to advance to the next slide, please. So one more back. Well, I guess this work would not have been possible without the great input from my co-authors, David Silverman and Steve Arvez at the Financial Health Network, as well as the fantastic folks at NORC at the University of Chicago, who were our survey vendor and really excellent research partners on this. We can go ahead to the next slide. So I won't talk about all the findings here today. I'm happy to share the report with you all and encourage you to take a look. But for a few key findings here, with respect to data portability, or the conversation around Section 1033 that we have here in the US about consumers' right to share their financial data, 62% of consumers think their bank or credit union should be required to share data about them if they direct it to. We had a couple of questions around data privacy. Some really interesting findings, I thought, were that approximately 90% of consumers are in favor of an opt-in standard for data sharing, whether it's from banks, tech companies, or FinTech apps. Similarly, about 90% of consumers think that banks, FinTechs, and tech companies should not share data about them for marketing purposes. They did not find that to be a compelling need for data sharing. And 87% of consumers are in favor of data minimization, but interestingly, only 41% think it's taking place in the market today. And I'll talk a little bit about that next. So just a few more is that consumers' views on data portability, data minimization, and opt-in standards didn't vary with political party affiliation or with any other demographic group. We saw a broad consensus in favor of all of these measures, and I'll talk a bit more about that. And then just a bit more contextual, 68% of bank consumers had linked FinTech apps to their checking account. And interestingly, 93% of FinTech app users and borrowers weren't aware of data aggregators' presence in their financial lives, which I think gets to the point that I think both Rob and Stuart were making very well as well. So if we want to move forward, I'll talk about a couple themes here, and then we can open it back up for discussion. So first of all, I think both Rob and Stuart made a lot of really good points about the lack of consumer understanding that we see in this space. Just to give you one example from our survey, here was a question really about data minimization. How much of your checking account data are FinTech apps capable of accessing? And here we see that a full third of consumers didn't know. And then it was, 41% thought only the data they need, and 25% thought all the data. But I think that the bigger point here is that we see this pretty even split, which kind of tells me, given the evidence that we've seen before about consumers not reading the disclosures they're presented with, that really there's quite a bit of confusion here about what's going on in this ecosystem. Now contrast that with the next slide, if we move forward, about what consumers prefer. And here we see that when you just ask how much of your checking account data should apps be able to access, we see that a full and overwhelming 87% of consumers would prefer that they only be able to access the data they need. And so going back to the point around data minimization, I think this disconnect between the data ecosystem that consumers want and the one that they think they're operating in today is a really key point, and really is something that policymakers and industry leaders should be paying attention to. Next slide, please. But moreover, I wanted to also just ask a broader question and take a step back from the legal and regulatory paradigm that we're operating in, whether it's Gramm-Leach-Bliley or anything else. Are disclosures enough? We've seen, and I think there's been some really good research that's indicated that consumers would need 25 full days to read all the disclosures they're presented with from the websites that they visit in a calendar year. So that seems to me to say that it's fairly unlikely that consumers will or even should engage with all of those disclosures. In our research here, we found that, as you can see, the vast majority of consumers either didn't read at all or merely skimmed the privacy policies from banks, from fintechs, and from tech companies. And I would also point out just sort of the consistency among those responses to show that, even banks, which consumers are much more familiar with, they weren't engaging very much with those privacy policies either. And then when we ask them, does your provider, whether a bank, a fintech, or a tech company, allow it to give other companies access to personal data about you, the majority of consumers in both of those cases still reported not knowing. Even among consumers of fintech apps who reported having read most or all of their fintech app's privacy policy, about a third reported not knowing whether or not the app could share data about them. So I would just posit that disclosure doesn't seem to be working as a privacy protection mechanism. Next slide, please. And finally, I think what consumers really want, and this gets to the point I made before, is a privacy by default framework. When we ask consumers, again, among banks, we have PFIs in these graphs, which stands for primary financial institution. Banks, fintechs, and tech companies, whether they would like that provider to give other companies access to personal data about them for marketing products, overwhelmingly, over 90% of consumers said no. And when we asked whether they would prefer an opt-in or an opt-out standard for data sharing, we overwhelmingly saw that consumers would prefer an opt-in standard for data sharing, which is, as many of you might know, contrary to the regime that we see under Gramm-Leach-Bliley today, even for banks. I think one of the quiz questions earlier said, are fintechs able to share data about you for marketing purposes? And correctly, the answer is yes, they are, but so are banks, depending if a consumer doesn't opt out. And so I think that's an important point to make here as well. Next slide here. And finally, and this is, I think, a positive note to end on, or at least I hope it is, just given the general polarization that we see today, all of these measures, whether consumers being in favor of data portability, consumers being in favor of data minimization, or consumers being in favor of privacy measures, even very minimal ones like opt-in standards, are overwhelmingly supported by consumers regardless of political party affiliation. We also see that there's broad consensus among all demographic groups: race, age, educational background, income level, even the types of banks consumers bank with, whether small banks or credit unions or the largest financial institutions. There are broad consensus on these issues. If you're interested in some more of that data, I'd refer you to our report. But I'll stop there. I know we have a lot to cover, and really looking forward to your questions and diving into the conversation.
Great. These are great presentations. Can you all come back on camera now, and we'll hopefully take some of the questions from our attendees. Nelson, do you have any questions coming in? While Nelson gets up to speed, maybe I'll ask a question of all of you. Really liked your presentation. I'm going to get a little wonky policy-wise. I'm going to ask you to weigh in on what you think are the most important aspects of President Biden's executive order encouraging the CFPB to act on Dodd-Frank's Section 1033 data access. And anyone that would like to answer can jump in.
I'm happy to take the first shot at that, Linda. Thanks. I think it certainly is a force in encouraging the CFPB to move forward, though I would say I'm not sure how much of a force it really is. The CFPB was already working on 1033. They have been working on 1033 for years. They published the guiding principles for data access sharing, which have provided in broad strokes, the industry with guidance over what the CFPB's vision for data sharing is, and we've all done a lot of work in reliance on those principles and building out infrastructure. The CFPB had already engaged in the ANPR, signaling that they were going to move forward with a rulemaking on 1033. That's a really important first step. And now with Director Chopra's appointment, we would expect the CFPB to proceed with that rulemaking sometime in the not too distant future. So I think it's one data point, but the CFPB was already well along in that direction before the executive order came out.
Good point. Anyone else like to weigh in on that?
Yeah, I'll just add on. I think Rob's right that the CFPB was already moving on 1033. And so in terms of whether the CFPB would or would not take that on, I don't think it makes too much of a difference. However, I think there were a few points that were pretty interesting. One, just being the provision about encouraging the CFPB to use its UDAP authority to police competition issues in financial services markets, I think is pretty interesting and potentially impactful. And second, a little bit disconnected from 1033, there was another provision in the executive order encouraging the Treasury Department to write a report on competition in financial services, which, while not a regulatory action, I think can be quite interesting and might spur a lot more thinking from other regulators and legislators as well. So I think there is quite a bit of interest here, and hopefully we'll reinvigorate the conversation around competition in financial services, which we haven't heard it that much about for a while.
Mm-hmm. Well, I think that's interesting, and I'm glad you brought that up, Dan, because a lot of people probably don't realize that 1033 and the work the CFPB is doing, one of its goals is to increase competition in the banking industry. And that's one reason why we have this development of these apps that want to have access to bank accounts, and bank accounts even creating their own aggregation tools as well. So very interesting. Nelson, do we have any questions coming from the attendees?
Hi, Linda. This is Linda Williams.
Hi,
I have
Linda.
a question. I have a question. The Community Reinvestment Act encourages financial institutions to help meet the credit needs of the communities in which they do business, including low and moderate income neighborhoods. Currently, non-banks are not required to comply with the CRA. Do you see that changing?
Does anyone want to jump in on that?
I'm happy to lead off again. I'm not sure that we see it changing, that anyone can predict that, but I certainly think that it should change. I think it is very important that institutions that are engaged in like activities be regulated in like ways. That's the only way you get true competition and a true level playing field. Banks need to adhere to CRA. There are lots of fintechs out there that are engaged in very similar activities that do not. And so I think it is a very important principle that should be applied across the board.
Great, and this is Nelson. Can you hear me? I have a question from the audience.
Yes.
And sorry, I got bumped off a little while ago. Somebody's asking whether Akoya offers an app directly to consumers or work through sponsored banks apps.
Thanks for the question. Akoya does work through the sponsored bank apps, and it's done deliberately because that's who we believe the client has an ongoing relationship with. So for a client who uses a FinTech app, who then just stops using it because they downloaded something, they tried it out, it didn't work for them, or they just stopped using it for any reason, their ongoing relationship is where their money is, where their paycheck might be being deposited or the Social Security check is being deposited, where they pay their bills from. So we believe that a consumer will go back to that bank and back to the bank website or back to the bank mobile app, which is where the bank can show them which apps have access to that account and give them sort of a dashboard, if you will, to show which apps have access, what accounts they have access, when it was last accessed, and give the consumer the ability, therefore, to monitor there and also to revoke that consent. So instead of going out and building a big consumer brand and having people come to Akoya, right, the relationship is, we call it where their money is, so point them right back there.
That's a good answer. I like that. I think that one thing we haven't actually talked too much about is the fact that the banks are coming on with dashboards or interfaces where their customers can go to check security in terms of what they have linked their bank accounts to. And I know that most of the banks that are associated, that are part of the clearinghouse at this point, have these dashboards. My criticism at this point is just that they're a little tough to find even when you're a customer. But once you know where they are very helpful things, because you can actually disconnect the app directly from that area of your bank. So I think that, you know, the more banks that, and credit unions and financial institutions that get on board with this, and I have noticed them at the major banks the clearinghouse works with, as well as some credit card companies. I noticed one at Capital One where I have a card. So I think that these are things that consumers will be learning more about in these coming months and will find extremely useful.
Yeah, Linda, that's right. I'll just say it needs a little education. I laughed when you said they're hard to find. You know, I ran websites for part of my career, and every product manager wants their thing on the homepage of the website, right? And you can't do that. But there are things that banks, you know, probably should do as part of this, which is to send reminders to clients either through a message or on the website or an email or their regular communication. You know, periodically, maybe a couple of times a year, remind consumers that they have connected accounts, review it. Do you still want them connected? If so, leave them alone. If not, make a change. So at least it could be a process to help consumers get there, even if the consumer's not thinking about it.
Hey, Linda,
Nelson,
if I could just jump in there for 1 second
yes,
as well.
Dan, go for it.
I think it's also probably important to point out that I'm pretty sure a few of the leading aggregators are also working on data permissions dashboards, which can be really useful for a consumer in terms of managing their consent. Now, as we mentioned before, consumers are unlikely to know about aggregators' presence in the ecosystem, and so that's a hurdle that's going to have to be overcome. But given the genesis of Section 1033 and the idea of data portability around incenting competition, I think it's really important for consumers to be able to manage these things, not only at the bank level, where, for example, some competitive interests might get in the way of allowing consumers to have the full breadth of data sharing that might increase competition the most. So I think that's an important piece as well. And to that point, I think consumers probably should have the right to appoint an agent or representative to be able to act within this ecosystem on their behalf as well. And so some of the banks may not be as comfortable with that. I know there's a bit of push and pull there, but that's something that we thought a lot about as well.
And I'm sorry, I have to respond.
Go ahead.
Dan, I just have to disagree with you, a little bit. I know some aggregators are building those dashboards, which are unfortunately limited to only the accounts that pass through those aggregators. So if you have an account at a particular bank and you use 3 different apps, and those 3 different apps use 3 different aggregators, the only place that you're going to see all 3 is back at the bank. And unless someone is acting as your true fiduciary, right, which has a lot more than someone who just maybe has the right to go get data, and if we want to call it that right, unless they're acting as your true fiduciary, I think that having it where the money is where the consumer's focus would go back to, and make sure it's complete. If we can ensure it's complete somewhere else, that's another story. But the way they're being built is actually they're all incomplete. They don't interact with each other.
Right. The one that's come to my attention here is the Plaid portal, and Plaid works with a number of banks. And as Stuart notes, you will see only connections that have been fostered through the Plaid network. So you wouldn't necessarily go to the Plaid portal and see your Akoya connections there. So this is something that people are kind of learning to understand now, but it is slowly sinking in that people can go to their banks now and see these dashboards, and I think that that's an important thing. Nelson, do we have any more questions?
Yeah, I have a couple of related questions. I'll ask them both since they relate to disconnecting from the apps. someone's asking, what are the proactive steps we can take to remove FinApp's access to our data? And related, if you change your password on a bank account after you no longer have a relationship, with an app, will that stop the app from gaining access? So steps to remove the connection from apps, and then is changing the password enough?
Listen, I'm happy to start there. So in the, we'll call it the current world or the old world of screen scraping, I'll take the question sort of in the reverse order. Changing your password is a great way to stop any app or anyone else who has your password from accessing your account. It's quite inconvenient because then you, the consumer, have to remember a new password, of course. And unfortunately, consumers have trouble remembering lots of different passwords. But that will work. In terms of disconnecting an app, that's also one way, is change the password. Another way is just go to the app, and you have to find it in the app. And unfortunately, every app works differently. But there are ways to tell the apps to stop. Right? You can unlink your account. You can tell them you want to delete your account and all your data. But you have to actually take an action in the app. Don't just delete the app from your phone. Right? Deleting the app from your phone just gets rid of your access to the app, but does not stop the app's access to your data. You have to make sure that you're actually going into the app and disconnecting it from the data.
That's very true, Stuart. That is one of the issues in our educational project, which you may think you know a lot about this area, but it's worth a gander over to our educational project, because it really has a lot of the details about how people think about how they can disconnect an app and how they really need to disconnect an app. And I think that a lot of people, as we've seen with the questions we've asked and the polls that Stuart and Rob and Dan have run, that there's a lot of misconceptions about this. People really don't understand it exactly. Nelson, did we have any other questions?
Let me turn it over to Linda. Did you have anything, Linda?
Yeah, I mean, I'd like to ask,
Linda Williams, sorry, Linda
okay,
Williams.
sorry.
Okay.
Linda Williams?
There's one other question. The Federal Credit Reporting Act gives consumers the right to know what information is being collected about them, how it is being used, and when it impacts them adversely. Are FinTech or data networks of these third-party middle people required to comply with the FCRA?
Well, I mean,
I think there's a lot of lack of clarity there, Linda. We
Yes.
have a legal and regulatory analysis that we put out last year that takes a really deep dive into that. I'm happy to share, which I think gets at the various questions at play. But I think it depends, first of all, whether or not the aggregator thinks they are a CRA under FCRA. And then I think there's a lot of use case questions in terms of once we get into what should and shouldn't apply. But I'm happy to share that with you.
Great. I'll
And
pass it on.
I would agree with Dan. I think there's an extraordinary lack of clarity over who's covered by FCRA in the data aggregator and FinTech world. And I suspect that it's one of the things that the CFPB may clarify as they move forward with 1033.
I agree. I was going to jump in on that. One of the
We have a
things,
couple-
go ahead, Nelson, go ahead.
A couple more questions here. How is the issue of financial data sharing expected to change as cryptocurrency increasingly becomes used as a means of payment?
Whoa.
Go
ahead, Dan.
Rob, go ahead.
Well, I mean, it's a fascinating question, right? So, I mean, I think cryptocurrency is a really broad world, and there's lots of different ways that you can operate a cryptocurrency. I think the one that we are most familiar with is Bitcoin, which is decentralized. So, I guess one could potentially imagine a decentralized cryptocurrency with some sort of automated bot that the consumer would give, their credentials to, and that then could screen scrape and do lots of other things. I mean, I don't think we've seen that yet, but one could envision that world potentially. I think the challenge with that world, like the challenge with all things related to cryptocurrency that is run in a decentralized fashion, is who do you regulate? If you want to impose standards, there's no one there to impose standards on. There's no one there to be responsible when things go wrong. So I think, if you think about crypto and in a decentralized world or decentralized finance generally, and the ability to gather data combined with that, I think the real problem is that, how do you regulate it?
I would agree with Rob, and I think that's sort of the conceptual fallacy at the heart of a lot of the cryptocurrency issues, is this sort of lack of an entity to regulate or to impose other obligations on to protect consumers. And so, I'm not sure how much it is being used as a means of payment. I know there's a lot of issues with using it that way due to volatility and a lot of other issues. But yeah, I think the big question comes down to what type of actor are we dealing with here?
Mm-hmm.
Excellent. And we did receive a very well thought out question that I want to make sure we get in. I think it's for someone who does, has some experience in this field. They're asking, at least some of the aggregators want to move their clients away from screen scraping and to APIs. But some fintechs say that they need to see the activities of their clients, and some banks are not prepared to build APIs. What would you say to a fintech that feels that its service is beneficial by virtue of the fact that the customer uses it, and thus they should be able to monitor accounts using screen scraping? Fintechs, for example, say they monitor to look for opportunities to offer better products if they see surplus monthly cash flow to justify an ability to repay new debt.
So I'm happy to lead off. I mean, I think, no one should be in a position of saying that screen scraping is good or that credential-based access is good. The most I think you might be able to say about it is that it may be a necessary evil until such time as we build out a more robust API environment. I mean, that's the work that Stuart's engaged in. It's the work that the clearinghouse is engaged in. And, let's face facts. I mean, this is not cheap or easy. I always scratch my head a little bit when people accuse the banks of being anti-competitive, because they sure are spending a lot of money to enable an environment for data sharing and then be accused of being anti-competitive. We sure are all working really hard to bring this environment about. And I can assure you that our banks are 100% behind enabling safe and sound data sharing. But not every bank can do that. Not every bank has the technological wherewithal of a Wells Fargo or a JP Morgan Chase or a Bank of America. And that's where Stuart and the work that he's doing come in, because it enables these smaller financial institutions, either directly or through their core providers, to connect to a utility that can radically streamline their approach to data sharing. So I think that's one issue. The second issue is that increasingly, I think we are looking at an environment where it will be important that there be some regulatory stake in the ground that screen scraping ultimately has to come to an end. Now, there's going to need to be a process to get there. We've seen the regulators do this with things like LIBOR, which were inherently a flawed practice, and move the industry to something else. But absent that regulatory stake in the ground, it's going to be very difficult to convince all of the parties to do the work that they need to bring about an API environment. The default is always to go back to screen scraping or always to go back to credential-based access. So there's going to need to be some sort of push.
Rob says it a little more delicately than I do. Credential-based access is a threat to the financial system, period. There are billions of stolen credentials out on the dark web today that potentially have access to individuals' financial accounts. We are one cyber event away from everyone needing to block screen scraping. FinTech apps that rely on screen scraping are built on a very, very shaky foundation. The faster we can move to secure, transparent access, the more solid those fintech apps are going to be. Yes, it's an immediate change that folks need to make. This is not coming from me. The Treasury Department said this. The Federal Reserve has said this. The OCC has said this. Right? No one has like implemented a rule that the industry must change, which is why the industry has been frankly slow to change on all sides. But it is an accident waiting to happen. Right? You can have credentials out in in public, which is where they are today, and expect the system to remain secure.
I would agree with everyone. I think almost everyone would agree that credential-based access and screen scraping is definitely something this ecosystem has to move away from. And I think Stuart's analogy of a shaky foundation for the financial data ecosystem is exactly right. I would say that I worry a little bit about some of the risks associated with moving away from it too quickly, in particular for small financial institutions, and because of just the scale of it in our system right now. I think really when we talk about screen scraping, what the debate actually comes down to is the scope of data access. And we've seen, aggregators probably unwilling to put down that tool because they feel that banks have been a little bit overly protective of, things they consider to be confidential commercial information, even including things like price in different cases. And so I think that's really what the debate is about. And I think that points to a role for the CFPB to, clarify that 1033 is in effect and to clarify what can't be withheld as confidential commercial information.
Mm-hmm. Very good answers all around. I think also this serves as a reminder for all of us to look and see where we've shared our data, where we've shared our banking login and passwords, and either at our bank's dashboard if you bank there with one, or certainly look on your phone and check every FinTech type of app that you might have there and make sure that you're still comfortable with and have a need to use that. What we also find is consumers just abandon a lot of the apps. They don't like the way it works or whatever, but they forget to go to these extra steps they really need to take to cut themselves off entirely. Nelson, do we have any other questions?
Linda Williams, anything from you?
Yes, one last question. Someone is asking, as we learn from the true and false questions, FinTech apps are not prevented by law from sharing or selling information about the consumer to third parties for marketing purposes. Is there any law or any steps a consumer can take to prevent them from selling or sharing the information with debt collectors?
Debt collectors in particular, the person asked?
Debt collectors.
Well, I mean, there are privacy laws in this country that companies must abide by. I think the problem here is that things are not really sewn and buttoned up enough to satisfy all of the people's rights to privacy in this arena.
I'd have to go back and look specific to debt collection, but I mean, even under Gramm-Leach-Bliley with which the privacy rule, which banks are subject to, there's not a prohibition for banks there either, as long as the consumer doesn't opt out. And there's a lot of other exceptions to that rule as well. And so I think, Linda, you're right. We do have privacy rules in this country, and I think the financial services sector is actually relatively highly regulated with respect to privacy compared to a lot of other industries. But the bar is so low in the United States is, I think, the issue we're dealing with.
Dan, I would add that even with Gramm-Leach-Bliley and the safeguards rule, most data aggregators and most fintechs argued that they're not subject to Gramm-Leach-Bliley or the safeguards rule. If they are subject to the safeguards rule, it's the FTC safeguards rule, not the financial regulator safeguards rule. So there's really a huge delta between what the FTC safeguards rule says and the protections that they're provided in the federally regulated financial system.
And let's not forget that in the case of most data aggregation terms of service that customers agree to, basically the data use is anything permitted by law. Right? So as long as it's permitted by law, it can be used. In the case of debt collection specifically, what's very interesting that you can learn from someone's transactions is the date they get paid. Right? So you know when the high water mark is coming, in that person's checking account. So you know when to redeposit, right? When to do a debit, when to go after the customer. When the customer may not have, specifically given permission for that use case. In the case of an app where they've disconnected, maybe they just deleted the app and did not actually disconnect the data gathering. So it all goes back to the disclosure. Does customer know why they signed up for something? What's being done with it? Is it only the data needed for the particular use case, right? If you sign up for peer-to-peer payments, no one needs to see the transactions, right? They only should see the account and routing or a token, right, and a balance. So I think it's real important that we get to a point, and hopefully through the rulemaking, that we get very clear with consumers on what they're sharing, who they're sharing it with, how they can monitor, and how they can disconnect.
And I would add that I hope the rulemaking does come down pretty squarely on which laws apply, although the CFPB has made clear about fraud and unauthorized use. I would like to see, more clarity around which laws apply to this, the players in this ecosystem. I've heard many people in this ecosystem, the various players, say they think everyone should be treated fairly in terms of what regulations apply to their work. So, so that's one thing that we hope to see out of the CFPB rulemaking. And I think we've touched on a couple of other things as well. Would any of you like to jump in for absolute must-haves that you hope would come out of the rulemaking at the CFPB?
I can never let this opportunity go by without talking about liability. What happens when something goes wrong? What happens when one party, this is a chain of data, right? Moves from a bank, maybe to a data aggregator, to a FinTech, to the consumer. What happens when something goes wrong and that causes another party in the chain harm? Right? Money is stolen. Right? Obviously through, the customers can go to the bank if money is stolen from their account. But what happens if it's because of an action that happened by another party? Right? We do not have a good way today to adjudicate liability, in that situation. And if we're giving entities regulated access to data, we need a way to adjudicate liability when a consumer is harmed.
Good answer.
I'm happy to go next. I think, from our standpoint, meaningful regulation and supervision of data aggregators and their FinTech customers. We currently exist in an environment where data is being transferred in many cases, very sensitive, personally identifiable financial information from the regulated financial system, which is supervised and examined for data security practices and cybersecurity practices and how and what they do with data, into a largely completely unregulated ecosystem of data aggregators and FinTechs. And the CFPB really needs to address that to ensure that consumers are protected, regardless of whether they're dealing with a financial institution or they're dealing with a data aggregator or a FinTech. And in order to do that, we need meaningful regulatory standards that apply to data aggregators and FinTechs, and we need meaningful supervision to enforce those standards.
Dan, you have anything to add?
I think I agree with that, absolutely, with everything Rob and Stuart said. I think definitely supervision of data aggregators is needed. I also think the Bureau should be working closely with the Prudentials to make sure that the Prudential's third-party risk management guidance and the forthcoming 1033 rule don't sort of step on each other's toes there, because I think direct supervision is needed. And I think we already talked about FCRA and the need for clarity there, as well as around liability and EFTA. I think I would just underscore the need to determine what data can be excluded or can't be excluded as confidential commercial information. as well as some other issues related to minimization. There might be, the Bureau might not be able to go all the way on some of those issues as it pertains to data aggregators or fintechs, but it should go as far as it can, because as I said, I think a lot of the issues that we're talking about here really do come down to the scope of data access. And once the Bureau can provide some clarity there, I think a lot of the other issues hopefully will be worked out quite a bit more easily.
Mm-hmm. Yeah. I think in Europe, the open banking laws have been developed in one way, but in this country, we already have so many players in the industry taking part in the industry at this point in time. I think, do you think that when the CFPB does the rulemaking, it should make sure that the players that are already in the industry, we have the competition that exists, still exists later on, and that many of the technical details are basically technology neutral? Do these things need to be said to foster the kind of ecosystem for fintech in this country that we seem to already be going down that road, as opposed to one government entity that monitors the access?
I mean, I'm happy to lead off. There's a lot packed into the question you just asked, Linda. I would say that we already have a very robust data sharing environment in the US. I mean, it's not done the way we want it done, but it does exist. I would also say that we already have probably one of the most competitive financial services markets in the world, with a whole lot more players in it, be they fintechs or banks or other players than exist in other parts of the world, including in the United Kingdom, where they do have open banking. And finally, I think when folks point to open banking in the UK, one of the things that they forget is that a precursor to that open banking environment was the imposition of meaningful regulatory and supervisory standards on the entities that were entering the financial system, be they fintechs or data aggregators or other players. And that is an incredibly important component that will be needed if this robust environment is going to flourish.
Agreed. Good answer. So I guess we're running out of time here. So can we go on to, I'd like to thank all of our speakers, and I think it's been a great discussion. And thanks to Stuart for mentioning the L word, liability, which hadn't been mentioned up to that point. And I was hoping somebody would jump in there with that. Seems to be a real sticking point at this point in time. But thank you all for your participation. I think that this webinar serves as an additional important piece of our educational project, and it will be put on our YouTube channel and recorded. But thanks very much. And could you advance my slides one more time? I'm going to, in the shameless self-promotion department, I'm sorry, I'm going to mention the fact that we are celebrating our 50th anniversary. And the theme is Shaping the Future, Honoring the Past. And we're going to present our Consumer Excellence Awards to Senator Sherrod Brown of Ohio, and National Capacity, the influential Asian American and Pacific Islander Community Development Organization, and the Popcorn Finance Podcast, which some of you may have heard. It's created by LA area entrepreneur Chris Browning to empower consumers to manage their finances in the very time it would take to pop a bag of popcorn, which is certainly, I don't think I could fit that in there, but he does. And to mark our milestone birthday, we're also going to honor 10 colleagues with special recognition certificates. And those are kind of small, but they're down there, and include some of our most recognized consumer advocates, as well as community people that are working on housing and other issues, as well as people that have just helped us along the way. So complimentary tickets for anyone who would like to attend, and we hope you can join us for one or another of these events. Let me know at editor@consumer-action.org, and we'd be happy to host you. Thank you very much to the speakers today, and enjoy the rest of your day. We're done.
Thank you.